All right, 30 minutes until the start of trading on what feels like Thursday to a lot of us, including me. I'm Matt Miller.
But it's really Friday for most of us. I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, from hopes of peace to escalation fears, once again, President Trump offers no clear timeline on Iran while pledging more aggressive action ahead.
The month-long turmoil forced traders to unwind position, with some of the world's biggest hedge funds posting heavy losses in March.
And Apollo's Jim Zelter downplays concerns about private credit, even as firms curb withdrawals amid a surge in redemption requests.
I mean, it's Blue Owl's redemption request this morning. That's everyone's attention. 41%
massive
for their tech fund.
Massive.
And of course, they're putting up the gates and just giving.
But if you know they're only going to allow 5%, then you have to request 100% of your money back.
And maybe that's what happened. They say only 10% of investors in the fund asked for their money back. Matt, here at the Open, I'm watching some of the big Mag 7 stocks. A couple things going on. For one, they're all getting hit just because of the negative sentiment in the market. But Tesla specifically down. They had deliveries in China, which were poor, and their first quarter deliveries just coming out. That misses estimates at about 358,000. The estimate was set 372. Shares down 3.4%. Meta, Alphabet, those also falling as well. They're plunging even more as governments scrutinize their practices. Indonesia, Matt, you pointed this out to me, issued a second summons to ban social media for kids.
Yeah, and I think more than 200 child advocacy groups have called for YouTube to ban AI from the kids' platforms. Of course, YouTube owned by Google. Let's look at energy stocks this morning. Surging on the rising price in oil. So Apache, Marathon, Valero, Diamondback, all up 3 or 4% as oil rises, futures fall. Take a look at cross-asset piece here. S&P futures, NASDAQ futures down pretty sharply, almost 2% for the tech-heavy index. And then oil surging, and you have NYMEX crude up 12% right now, Brent up 8%. And in fact, Brent is priced at lower than NYMEX on the front end, or the front contracts. And Dani, I guess that's because what? Brent crude is trading a June contract?
Yes. And then WTI is still trading at its May contract. And as is usual on the curve, the closer you are to the contract, the higher it's been trading right now because of all the drama, and then it starts to fall off. So that's the reason for the disconnect at the moment.
And this all coming, the surge in oil prices, after President Trump in his primetime address said the U.S. operation in Iran is close to completion, but he signaled an escalation ahead.
We're going to hit them extremely hard over the next 2 to 3 weeks. We're going to bring them back to the Stone Ages where they belong. When this conflict is over, the Strait will open up naturally. It'll just open up naturally. That will resume the flowing, and the gas prices will rapidly come back down.
Joining us now is Wayne Sanders, Bloomberg Intelligence Senior Defense Analyst and a retired Army Colonel. Wayne, I mean, it's a market that decided we didn't learn anything new from the speech last night. What was your takeaway?
No, I agree. I think nothing has really changed in terms of military posture, where we actually are right now. You've seen an escalation, an uptick of deployment of assets over to the region that does still support what could potentially be, an increase in activity over the weekend. If you look at the air assets, you have increased A-10 deployments, which is a close air support aircraft, as well as Apache helicopters. You have the B-52s in the area. So in terms of trying to actually create an increased airstrike capability for over the weekend, that the U.S. is ready to do that. They have the means that are able to be in place. The Straits of Hormuz being naturally open, maybe some of those targets will actually be coastal missile storage facilities along that area. You could see the A-10s and the Apaches actually coming through and softening targets in that area, similar to some research that we put out last week.
It's unclear to me, I think unclear to a lot of people in the markets, whether they're opening the Strait of Hormuz is a goal, is an objective. He said he won't accept a ceasefire from Iran unless the strait is open. Also, we've heard Pete Hegseth say it's not an objective. And it seems like the administration isn't terribly concerned about that. To me, more worrying, though, Wayne, is the more than 400 kilograms of highly enriched uranium that may or may not be in Iran, may or may not be accessible. What do we know about this material, where it is, and how long it would take the Iranians now to turn it into nuclear bombs?
No, absolutely. And it's probably for all intelligence professionals that are out there working in the government, it ends up being one of the biggest issues is confirming or denying where it is, how much they actually have, whether or not it's actually buried in one of the strikes that have taken place. And without boots on the ground, it's very, very difficult to be able to confirm or deny any of the presence there. And you increase risk substantially if you try to actually put any ground forces in the area to be able to find it. So at this point in time, the options are limited to saying, where is this? If you actually think you know where it is, you don't want the media, you don't want anybody in the public to be able to know that. You don't want the enemies to know that you think you know where it is. So it ends up being this gamesmanship play in terms of where those strikes are. Some of the strikes over the weekend, if it continues to escalate like this, could potentially be against targets they believe is where the enriched uranium actually is. But there's nothing that can confirm that at this point in time, and I'm sure they're going to keep that on the classified.
Can I just underline, though, this has to be the most important aspect of the entire war, right? Because we don't trust the Iranians, and we need to definitively confirm that they cannot build a nuclear bomb. After we killed the Supreme Leader's mother and father and wife and son, he should be very angry. So we need to confirm with no doubt that they can't make a nuclear weapon, don't we?
Absolutely. And even if we were to pull out of Iran, I guarantee you that would be priority number one for the intelligence community within the United States. They're going to continue to be able to put ISR assets, intelligence, surveillance, and reconnaissance assets on that. They're going to continue to use human sources that are out there to be able to confirm or deny where these things actually are. So even if the military strikes ended, this would still be a campaign that will continue. But their production facility and their ability to do something with it inside of Iran is obviously extremely degraded based off the amount of military strikes. So at this point in time, the intelligence community would also be looking for where some of these connective tissues are with some of their, I call it the big four partners between China, Iran, North Korea, and Russia, where that actually plays and whether or not the scientists are back involved, where would this actually take place, what labs are building it, and then whether or not they're actually doing any additional enrichment facilities. Right now, they've destroyed the ones that we know of. It's really a question as to where they could actually process it at this point.
Retired Army Colonel Wayne Sanders, thank you so much for joining us now of Bloomberg Intelligence. Now, the Trump administration is prepared to roll out a tiered tariff system on steel and aluminum imports after months of pushback from U.S. companies. Joining us now is Joe Doe, Bloomberg senior reporter covering corporate and economic statecraft. Joe, just before we get to the tariffs, I mean, this moment that we're in of Trump basically saying the strait will reopen naturally, it seems not to be an outright goal, although he wavers on that. There's a J.P. Morgan report saying that to get energy flows back to 99% of where they were, it would take something like 4 months. How is industry dealing with this? Again, before we even get to the tariffs.
I think you're seeing it bear out in the markets, right? We have had such choppy trading, volatile trading over the past month. The conversations that I'm having every day, whether it's down in Washington or here, whether it's with policymakers or investors, it's about the Strait of Hormuz. And it is about when confidence will come back to traverse the waterway, right? Because it's not closed. It's not closed. It's open for anybody to go through, but nobody has the confidence to send their crews, their their people through there to do what shippers typically do. What's it going to take? Well, I mean, that's what everybody's been talking about for, 5 weeks? And it's not clear, even from the president's speech last night, that he is laying out what it's going to take. We can take a guess, right? And one of the guesses is good old-fashioned diplomacy. You have Gulf states working alongside the United States, European nations working alongside the United States, and putting pressure on Iran, whether it's kinetic or diplomatic, to figure out a way to reach some sort of ceasefire in which the Iranians will no longer be a threat to attack tankers moving through the Strait of Hormuz.
So, the companies that I talk to, the automotive manufacturers, while they're concerned about, obviously, the price of oil and a lot of the raw materials that come through the Strait of Hormuz, they're the big bugaboo for them in terms of the bottom line have been steel and aluminum tariffs, especially if they obviously make cars here in the U.S. because they're penalized by these massive tariffs, and it's also a complex system, an incredibly complex system. So a lot of these CEOs don't even know how much really they're paying in tariffs or should be. What do we know about this simplification that is taking place on that level? Yeah, so last night we had a report out that the administration today is going to, or today or sometime in the next few days, going to announce a tiered system of tariffs around aluminum and steel products, essentially. So it's not the raw materials, right? It's not commodity grade aluminum or steel. It is things like steel pipes or extruded aluminum, right? The problem has been now for months. American companies have been telling the administration, they've been telling Howard Lutnick, they have been telling Jameson Greer, it is impossible for us to properly calculate the tariff that is supposed to be on things like vitamin C packages coming in, because there's a little bit of aluminum in that. The administration has heard that, and they have said, we have simplified it. We're basically saying there's going to be a value put on the product coming into the United States that has aluminum or steel, not the specific steel or aluminum that is in those products. It's a different range of 50%, 25%, or even lower. If you want to get into the details, go to Bloomberg and find out where we go into that. But like one of the sources told me, it was like, dude, we had dental floss coming into the United States, and because dental floss has a small piece of metal to cut your floss, people couldn't figure out the tariff they were supposed to be charged for that. So they are simplifying things like that, getting that off the table, so that American businesses, which already have so many troubles that they're dealing with, can just say, okay, this is one of the ones that we don't have to waste our time worrying about anymore. All right, Joe, great having you here on set. Joe Doe, and highly recommend subscribing if you have a Bloomberg terminal in front of you to the Global Trade War newsletter. You can get these updates, important updates for business, obviously, and they come down to earnings results in your inbox every day. Tesla delivered, speaking of, 358,000 cars last quarter, missing estimates of 372,000. Let's get the latest from Craig Trudell, Bloomberg's managing editor for global business coverage. So, Craig, what do we know about Tesla's car-making business? Obviously not a huge part of its massive $1 trillion-plus valuation.
Yeah, absolutely right. I think it's not a huge aspect of their valuation perhaps anymore, and yet it is what sort of pays the bills. And this is a business that has been trending in the wrong direction for a couple of years now. I think, the year ago comparison here was, sort of as easy as they come, right? First quarter of last year was one of the weakest since 2022. And so for this company to only manage about, a 6% call it increase year over year, when, the first quarter of 2025, they had significant production losses tied to the Model Y changeover. You had Musk in the White House making a lot of negative headlines. This is a really, downbeat showing from this company for the first quarter of this year.
Hey, Craig, thank you so much for joining us. With Tesla shares declining 4.2%, Bloomberg's Craig Trudell. I mean, at least if they're going to decline, they're going to decline 4.20, and Elon Musk would be happy about that. A quick check on markets this morning. A lot of negative risk sentiment piling up after no signs of de-escalation from the president in his address to the nation last night. We're down 1.5%. NASDAQ falls 2%. Huge moves in NYMEX and Brent crude. Just flagging, in case you're wondering why it looks like NYMEX is higher than Brent. NYMEX crude, that contract is currently the May one. You're looking at a June Brent contract, but both above $100 a barrel. But one of the biggest sources of pain in the market this morning. Coming up, shares of alternate asset manager fall. Blue Owl getting hammered, down 9.3%, saying that will limit redemptions from two of its private credit funds. We're going to get the latest coming up next, right here on Bloomberg Open Interest.
Let's get now to high interest. Look what's making headlines around the world. NASA's Artemis 2 crew is now in orbit around the Earth after launching from Florida, marking the closest return, or will be the closest return to the moon in more than 50 years when they go around it. The mission clears a major hurdle for NASA as it works toward building a lunar base and eventually reaching Mars. And $350 million is what UK developer Nick Candy just scored for his mega mansion in London's Chelsea district, making it the most expensive home ever sold. The estate boasts a private lake, a pool, and palace-style grounds. This is in Chelsea, by the way.
Crazy.
Yeah, more than 2 acres in Chelsea.
Does that exist in Chelsea?
I mean, I didn't know about it. The property sparked a bidding war despite a cooling luxury market and it not even being listed. The dude sold his Chelsea home for $350.
I can't even sell my tiny little flat in London.
Is it in Chelsea?
It's not far from Chelsea.
Maybe I'll take a look.
Okay.
Pressure keeps building in private credit, Dani, as you well know. KKR and Blue Owl are capping withdrawals in retail-focused funds after a sharp spike in redemption requests. Blue Owl saw demands as high as 41%, while KKR exceeded its limit and is paying out pro rata. The moves signal rising investor unease across, continuing unease across the $1.8 trillion private credit market.
Yeah, a painful number. Let's get more on Blue Owl and the broader asset management industry with Bloomberg private equity reporter Allison McNeely. And Allison, I mean, it's hitting all the giants this morning, but 41% redemption requests. I mean, that is a punchy number. I don't think we've seen anything close to that from some of these other BDCs.
No, it is by far and away the largest number we've seen. And recall that it's a continuation of the trend. We saw this last quarter with Blue Owl. You know, they did the asset sales of $1.4 billion of assets to try and meet redemption requests last time. And now, this time around, this quarter, they're saying, we're stopping at 5%. You got to get in line.
Yeah, and that makes sense, right? Because Blue Owl and others had exceeded that level previously, and that just... I mean, I don't know if moral hazard is the right term, but
well, I mean, you're supposed to be saying, look, these things are illiquid, and if you let everybody take out all of their requests, isn't it creating like a false illusion of liquidity?
I'm hearing from sources that there's actually a lot of anxiety and sort of debate within the alternative asset management industry right now about whether or not you enforce that 5% limit and essentially train the customer, hey, this is what you signed up for. You signed up for up to 5% of shares per quarter. Or do you do what, Blackstone has done, what Blue Owl did previously, where you stretch a little bit beyond the redemption limit to try and shore up confidence?
Allison, what are the fears? What are the knock-on effects of 41% of your money running for the gate, whether or not, you pay out?
Well, one thing we're watching really closely is whether or not these funds are continuing to take in new money. So, for example, yesterday we saw KKR extend or hit its limit of its redemptions, but it also had gross inflows. So, yes, more money was leaving, but still a healthy amount of money was coming in. Now, a lot of these funds are taking a lot of steps and a lot of measures to sort of reinforce confidence, saying, hey, we've got a lot of liquidity, we've got cash on hand to meet redemptions, we also have strong performance in the portfolio. This is market jitters, this is not reflecting anything related to performance. Please be patient, we will get you out, but maybe not as fast as you would like.
I do wonder, though, because for a lot of the large, publicly traded managers that you cover, their next leg of growth had been pinned on retail. Like, this was the big thesis of the next frontier because institutions are tapped out. What does it mean if maybe that slows down or isn't the next frontier?
So, and it's so awkward, too, because we had the 401k executive order, guidance come out this week. There's like a lot of stuff happening, and you're exactly right. Like, this is the next frontier of growth for these firms. This, I think, kind of like what we saw with BREIT a couple of years ago when more investors tried to get out of that fund as well. Blackstone really said this is like a teaching moment. We're confident in this vehicle. There's going to be some pain to work through, but we will get to the other side. And I think we also saw Apollo's Jim Zelter say the same thing this morning on television. He said this is kind of a moment of a bit of jitters, but we need to kind of teach, we need to push through it, we need to kind of let people know this is how it works and this is what you signed up for.
He seemed to be wearing rose-colored glasses. I mean, I recommend viewers go back and watch that.
Yeah.
It was a fantastic interview with John, Lisa, and Anne-Marie, but he was incredibly optimistic, seemed to think like, the war in Iran, for example, this is just a blip.
Yeah, I mean, On the other hand, what I would also say, what else are these firms supposed to do, right? Like if you want to ensure confidence in your product, you want to ensure confidence in the market.
But clearly there is some, like you were reporting on this morning, I mean, not credit, but KKR's private equity fund with a really big haul.
It's so interesting, yeah. So I think what we're going to see in private credit and in private equity is haves and have-nots, right? The folks who can kind of ride the turbulence. KKR has ridden through a couple tough years in private equity in the industry to bring in a massive amount of cash for their next fund. So they're going to be able to come out the other side of this likely winners. We're going to probably see the same dynamic in private credit. Some people are going to be able to get through this redemption spike, with strength and on the right foot, and others may not.
Allison, thank you so much for joining us this morning. Great to see you. Bloomberg's Allison McNeely. And we're going to get more on this sector, more on private credit. Armen Panossian of Oaktree, the co-CEO, is going to be joining Matt and myself at 10 a.m. New York time. And yes, indeed, it will be 10 a.m. New York time. Coming up, Goldman's Ben Snider talks about the S&P's weekly pump and dump pattern since the start of the Iran war. We start the week okay, we end the week not so okay. That's coming up next. You're watching Bloomberg Open Interest.
All right, we are less than 5 minutes away from the opening bell on this Thursday. And remember, this is the last trading day of the week in the U.S. because equity markets are closed for Good Friday tomorrow. S&P futures are down 1.5%. NASDAQ futures off 2%. And NYMEX crude is up $13 to $113 a barrel.
Yeah, you get a big turnaround from what you had yesterday, both Brent and NYMEX crude.
So much for being insulated.
So, yeah, I mean, clearly we're not. I mean, this has been said much before that there's a difference between what the paper market and what the physical market is saying. That's starting to trickle through to the U.S. Some of the movers on our radar this morning, oil and gas companies, no surprise, they are rebounding after Trump's speech. Also looking at airlines and cruise operators, those are slipping because of the other side of this, higher fuel prospects. And then finally, let's just round it out with gold and silver. Those prices are dropping after Trump's comments have been weighing on the miners. Some real volatility in the price of gold. Coming up on the other side of this break, it is your opening bell.
We are moments away from the opening bell. This is Bloomberg Open Interest. I'm Matt Miller, looking at futures that are down significantly after President Trump's speech yesterday, but also after, the massive rallies that we have seen. I think Tuesday was the best day that we've seen since May. And we had, more than 2% gains on the S&P. So it stands to reason as you go into the weekend, because there will be no trading tomorrow, that a lot of people want to get flat and are selling risk in order to enjoy their Easter egg hunts. At the New York Stock Exchange, you've got smart self-storage ringing the bell. The stock hasn't really done much this year or over the last 5 years. It's down a little bit. And then here's Nano Nuclear Energy, a stock that probably a lot of AI data center providers are going to be excited about. Dani, in terms of what we're focusing on, all of a sudden, once again, it's private credit today.
It is indeed. It's kind of this fear that keeps bubbling up despite everything else out there. It's breaking through the headlines. Blue Owl, it's not trading as poorly as it was in the pre-market. At one point, it was down 10%. But the news we learned only about an hour, 2 hours ago, Blue Owl is going to limit redemptions from 2 of its private credit funds to 5%. It had a surge, a huge surge in withdrawal requests. One of its credit income funds saw 22%. Its smaller tech income fund had 41% redemption requests. Craig Packer in a filing saying that, look, it was only 10% of clients that asked for their money out. The rest of the 90% are staying put. But still some pretty stunning numbers, Matt.
Yeah, well, I mean, that means 10% of clients
wanted all their money.
Have at least 41% of the entire fund.
Yeah, I guess it's a question of concentration, but also it's people who are maybe like, maybe I need to ask for all of this back because I'll get it back slowly and prorated, so it's exaggerating some of this, but it kind of has a snowball effect of more negative sentiment, as you can see here.
Yeah, it's definitely an interesting story. Tesla posted one of its worst sales quarters in years, missing Wall Street's expectations as the car maker struggles to turn around its core business and navigate an increasingly challenged electric vehicle market. And I will admit that even I, as a gearhead, don't find this story very interesting.
Wait, why?
Because who cares about Tesla's car deliveries?
Because they're not
right?
a car company, or
it's
what?
a $1.4 trillion company. I don't care if they sell any cars. It's all about robots now. And we have a great, by the way, piece on the Bloomberg terminal about John Neal, who used to be a president at Tesla, talking about how they were so good at ramping up in cars and how they will do that with robots. That's, I guess.
Can I tell you why you should care? Because the market cares.
Yeah.
Its valuation is huge, but it's down almost 4% this morning.
I do, but it's the Blue Owl thing I think is more interesting
I would
because I
agree with
have
that.
so many questions around whether or not this matters outside of private equity,
true.
outside of, a few software loans. Let's bring in Goldman Sachs Chief U.S. Equity Strategist Ben Snider. And before we get to, the war in Iran and the horrible month that March was and the fact that Thursday seems to be the worst day for equities, what's your take on the private equity drama? Does it really matter for the wider market, for the wider economy?
The good news is so far we don't think it's a systemic risk for the economy. The bad news is if you talk to our analysts covering these stocks, they don't expect the headlines to change anytime soon, which means the kind of dynamic we're seeing in the market today probably continues, and it's hard to step in and buy those companies.
By the way, I've seen kind of this thesis put forward of prior crises when you want to, it's, the whole sell what you can, not what you want to, that if people are trying to sell out of an illiquid fund, they eventually move up the proverbial food chain, and maybe that gets to equities too, and they just start selling that. Is there any evidence that that's happening at all?
We've seen a little bit of reduction in equity investor positioning, but so far I would call it broad macro pessimism rather than panic.
So what is happening with this pattern that we're seeing? And it's not just the S&P, but mainly. It gets bid up during the week. President Trump always says, we've won this war, and we only need a few more weeks to win this war. We don't need any help to win this war. Please help us win this war. And then on Thursday, we sell off.
Talking to investors every day, my sense is not many have an edge on predicting geopolitical events. I certainly don't. And so one result of that is if you look at the market, we're trading with a very close inverse correlation to oil. We're trading with a very close correlation to prediction markets. And that means, as you were saying earlier, when you're heading into a weekend where you can't trade, but the news flow is going to continue, it just makes practical sense to reduce exposure a little bit.
How much, though, have investors just overall gotten really close to the ground because of the volatility? Is this a market that you can be active in at the moment, unless you're, maybe trying to do a short-term quant sort of trend-following type strategy?
The strategy we've seen for many of our clients is, I think, the right strategy, which is to acknowledge the difficulty of predicting geopolitics and instead extend your investment horizon and ask yourself, where can I have conviction 6 months down the road, 12 months down the road? And for most investors, that is really nothing to do with geopolitics or private credit. It's AI investment spending. And so if we look at the most popular trades and some of the most successful parts of the market, even during the conflict, they remain the revenue and earnings beneficiaries of the hundreds of billions of dollars of AI capex that seems to be continuing regardless of geopolitics.
So I wonder if that's why we had Joe Weisenthal, the stalwart on Twitter, right, put out a tweet saying, we're only down 4% this year. And that's amid, a war, all the AI worries about software. The Strait of Hormuz is closed. The price of oil has more than doubled. Why is the market so sanguine? That's a fantastic outcome, S&P off 4% amidst all those worries.
One underappreciated dynamic that's happened during the last few weeks is as prices have declined, earnings estimates have continued to move higher, in large part because of that tailwind from capex that I was just mentioning. So, for example, if you look at the sectors most exposed to the energy shock, the energy sector and the consumer sectors, they account for about 20% of S&P 500 earnings. That's half the contribution from technology. So for investors, although the headlines are being dominated by geopolitics, it makes sense that the primary focus is on that tech investment spending.
By the way, just the counter to this, to play devil's advocate, this doesn't come from me. It comes from someone much smarter than me, Neil Dunna of RenMax, sending this note at the top of the hour, basically saying that the shock to gasoline prices works out to $120 billion. That's about 0.5 percentage points of disposable income. He goes on to say, what seems out of place right now is the fact that earnings estimates for publicly traded companies have generally been rising. I get that energy-exposed companies maybe deserve a bit of a shock, but what about consumer-exposed companies? If all of a sudden your income gets this hit from the increased amount that you're spending on gasoline?
We're about to head into the earnings season in a couple weeks. My expectation is we will see some downward revisions to consumer earnings. From an economic perspective, our economists have lowered their expectations for real consumer income and spending. I think that's very reasonable. But keep in mind, we're starting from a very elevated place, in part because of the tax refunds that are coming through right now. So it is a reduction in the outlook, but I don't think it's a kind of reduction that should lead us to really panic about the fundamental outlook right now.
What do you buy in a down market like this? I mean, what have you been excited about in March that's losing a lot of value? You watch your multiples. I'm sure you have an awesome dashboard on your Bloomberg. What are you excited about picking up?
So for us, the key strategy is, as I mentioned earlier, find a place you have conviction in the earnings outlook, where now perhaps valuations are lower, and even better if the earnings outlook has been strengthened by the recent conflict. And one place that checks all those boxes for us is solar energy and other parts of the energy infrastructure complex. Right? Because of AI and data center power demand, this has been an attractive theme for years. And now, very likely, because of the conflict, we're going to see much more investment in energy supply and resilience. That includes solar, pipelines, other parts of the complex.
And we're going to have to leave it there. Thank you so much for joining us. I hope your weekend does start at the end of the day today. Ben Snider, Chief U.S. Equity Strategist, Goldman Sachs. Let's get a quick check on your markets about 9 minutes into your trading day. And we're heading for quite the negative start to the trading session. We're down 1 1/3%. That means we undo the past 2 days of market gains, although it's been a little bit back and forth on that after the president's address yesterday. The gainers, it will come as no surprise, leading the pack in terms of points added to this S&P. It is the oil majors, Exxon and Chevron, adding 2.4 and 1.4 points to the S&P 500. Some consumer staple names, so also a safety trade. On the downside, as goes sentiment, so too does the Mag 7. NVIDIA, Apple, Broadcom, Amazon, Apple, Tesla, Meta, all having a very, very bad, no good start to the day. NVIDIA racing 10 points from the S&P, which is now currently down 92 points. Tesla having some of its own issues. Matt is not interested in it, but they did have miss on their first quarter deliveries. Meta and Alphabet also have their own thing going on with continued scrutiny from governments looking at the individual sectors of how we're rounding out the week. Energy back at the top of the pile, alongside, as I mentioned it, consumer staples. Again, one of the dynamics, just to point out, is that at the start of this conflict, staples and utilities were selling off because of positioning issues. So maybe we've worked through some of that. Now you can get back to a very classic type of risk-on, risk-off trade, where energy, staples, utilities does well at the bottom of the pile, consumer discretionary, and infotech. Matt?
Just when you thought you could get back to a very classic risk-on, risk-off trade.
Wait, no, I'm saying it is one. It is one now.
I know, but I'm just saying, like, something will happen.
Oh, yeah, probably.
Right?
I'm sure
There'll
you're
be
right.
a basis trade blow-up.
Yeah, I probably ruined it all, I realize.
Coming up, Tesla's deliveries may be in a new normal as sales growth slows down compared to recent years. And they're also facing increased competition from the likes of Toyota. We'll talk more about this stock next. This is Bloomberg Open Interest. Shares of Tesla extending losses. The EV giant delivered 358,000 cars last quarter, missing estimates of 372,000. Let's discuss with Bloomberg Tech co-host Ed Ludlow. He happens to be at the Kennedy Space Center following the launch of Artemis 2. And we will talk about the rocket faux show, Ed, but I want to talk first about Tesla's dwindling car business. I've heard they also have a lot in inventory. What's up with sales?
Yeah, I mean, it's the second consecutive quarter that the deliveries number has missed estimates, but there is still this large portion of the investor base, right, that sees Tesla's core car business being completely divorced from how the street values the stock, right, which is a future predicated on artificial intelligence, humanoid robotics, and robo-taxis. The production number also came in for the quarter far above estimates, which is kind of interesting. You know, Tesla had been due to start serial production of the Cybercab in the month of April. Maybe they pulled forward on that. They're ending the S and X permanently. Maybe there was a sprint finish to build some in the hopes that that inventory would be worked through. But the stock is down either way quite significantly, right, in a down market where as soon as the headlines hit, it dropped. And so that's something to take into account for sure.
Ed, what about competition for Tesla? Matt was pointing out to me a story that the team did about Toyota expanding its lineup in a way that could really pose a challenge to some of Tesla's cars.
Yeah, I mean, generally speaking, though, the electric vehicle market is still having a tough time of it in Western markets like the United States and Europe. And remember, in Europe in particular, Matt knows full well, many of the OEMs in Europe have many more models. They offer a wider variety of battery electric vehicle at very different price points. And the criticism with Tesla is it has a very narrow range of vehicles that it offers. And so it doesn't resonate with all corners of the market. That's just not where the story is right now. And like, I think, Rivian came out with its numbers, for example, and it's maintaining guidance, but it is a small niche volume player that's on the precipice of launching its first mass market product. So from its perspective, that's good, but it's not in aggregate something that's going to impact, how that market's viewed overall. Hybrids with Ford is an interesting case study. There's a lot of data that supports that strategy of going to hybrids has worked.
Chris Bryant also has a great story about picking up a used Taycan at $45,000 suddenly seems like a great idea. Chester Dawson has a really good piece on Toyota. The Autos team is doing a ton of great work. I want to ask about rockets, though, Ed, and I'll ask a question that I've asked you already numerous times, but I don't understand why it's so costly and so difficult and takes so long to repeat one time something that we did in the 60s and 70s 6 times. Like if there are leaks on the SLS fuel tank, why doesn't somebody just go grab a Saturn V from the warehouse?
So the SLS system is very focused on performance. There is little reusability in it. Actually, I'm going to try something right now if my cameraman Doug's paying attention. There's an RS-25 rocket over my shoulder. The RS-25 was on the shuttle missions. They've literally refurbished them. The inventory of RS-25s that they had from the shuttle era and modernized them for this. But unlike SpaceX, there's no coming back post-launch. You don't get that back. But that's not the goal that NASA's had. Part of it is also the many players. The SLS system is developed by Boeing. The Capsule spacecraft is developed by Lockheed Martin. The launch abort system is developed by Northrop Grumman. The European Space Agency in Thales did the service module. There are many hands and integrated teams working on it, which added to the complexity and cost, versus SpaceX, which designs its entire system top to tail. But, again, you have to give NASA the benefit of the doubt that in this instance, reusability and the economics of spaceflight wasn't their guiding light. It was getting to the moon with maximum performance in something that is a difficult technical feat.
All right, very cool. Ed, I always look forward to talking to you about rockets. I may just give you a call during the break or after the show. Ed Ludlow co-anchors Bloomberg Tech. That show kicks off at 11, and he maintains all of his wisdom, even without the beard, which I think is a feat in itself,
Is that how you feel about your own facial hair? That if you were to shave it all the way to
it's my only strength.
Oh, God, that's so not true. Okay, I'm going to save us all and move on. Let's get some top calls from the analyst action that we're focusing in on this morning. First up, KeyBank. They've upgraded Brinker, saying that Chili's strong sales were expected to keep going in 2027. The analyst is also confident that profits can improve and says new restaurant openings add to the upside. Next up, Chevron, EQT stand out as top LNG winners as the war in Iran tightens global supply. That's according to Melius Research. The firm says that oil field service companies like Baker Hughes, Halliburton, SLB will also benefit from a Middle East production rebuild. And finally, Baird is downgrading Akamai, saying that the recent run is fueled by excitement around AI and future growth, but it doesn't see that turning into real gains anytime soon. Shares are down 1.6%.
That's Akamai.
Akamai,
which
thank you for that.
I know because I've been to Tokyo it was only for 24 hours.
And you went there specifically to learn how to say Akamai.
I went there to buy jeans.
That's more productive.
Coming up, some of the world's largest hedge funds wiped out year-to-date gains in March due to the Iran war. We'll walk through the winners and losers with our hedge fund guru. I just saw Hema Parmar. There she is. She'll be back with us in 2 minutes. This is Bloomberg Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Quick check on stocks on this Thursday, which has been the worst day of the week for people long equities. It is the case today as well. S&P 500 down more than 1%. NASDAQ down 1 2/3% almost at 23,629. Obviously, people want to get flat into the weekend. You can't trade, as Ben Snider from Goldman Sachs was just telling us, so you want to get short your risk. In terms of Brent crude, it's up 7% right now, and the bigger jump is in WTI. So much for being insulated. NYMEX crude is soaring. Nvidia is down 1 3/4%. That's a problem because of its huge weighting. Tesla after the sales miss. Amazon and Globalstar in reported talks. That's very good for Globalstar shareholders. And then KKR and Blue Owl. We've heard the Blue Owl news today, and KKR and the BDCs are not faring well. Dani.
No, Blue Owl trading at its lowest intraday price ever. Bloomberg sources at some of the world's largest multi-strategy hedge funds say that March volatility drove losses after a strong start to the year. Bloomberg's Hema Parmar covers hedge funds for us and was behind this story. Hema, I mean, this is probably not great news, right? Because isn't this the whole point of a hedge fund, that when markets are freaking out, you return something that's uncorrelated?
Yes, you're seeing some numbers that are down 4% for the month, down 8% for the month. Some funds are about flat, which is a good month, and given the kind of environment we've seen. Hedge funds should protect in a down month and in a down year. I would think they would argue that given how stocks and bonds and wherever your money might be elsewhere, compared to that, they have lost less. But again, it's manager selection, right? So when it comes to specific firms, how are they doing? And when we look at, let's take, for example, Exodus Point, down 4.5% for the month, down 2% for the year. Balyasny, down 4% for the month. These are pretty sizable losses for multi-strategy funds. They typically, we expect them to be up at least 1% a year. And a percent a month, excuse me.
And they want to be not just uncorrelated with the broader market, but with each other as well. Are they all in the same trades?
It depends on the strategy. You see sometimes some billionaires have voiced concerns over all being in the same stocks on the equity side, and that potentially causing a spiral and a deleveraging event.
Yeah, because if they do poorly, they get cut, right? So the ones who are doing well, everybody probably looks at that strategy and says, I don't want to get cut.
Oh, so like in the pod shop kind of thing. All the money gets funneled to the winners.
Aren't they all pod shops?
Well, the multi-strats are typically the pod shop names, and you have multiple teams of traders who are given money and they can invest in silos separate from each other. They're supposed to make the firm less correlated because everyone's doing their own thing without influencing from one another. But we are seeing some dispersion within the pod shops, right? Millennium down just 1% for the month. Bally down 4% for the month. Walleye down about 1.3%. So you are seeing, even within this group of multi-strategy funds, not everyone's the same. And also, I should note, like, Exodus Point is a lot more fixed income than the other guys.
Hey, Hema, just while we have you, because you've also been reporting on this, is the drama that's happening at Two Sigma with the co-CEO, Scott Hoffman, quitting. What is going on? For those who haven't been keeping track.
It has been, I mean, maybe one of the most dramatic hedge funds we've ever covered. The two billionaires for years have hated each other. They have been feuding over many things about the direction of the firm. They both stepped down. They both picked proxies to run the firm. That was just like less than 2 years ago. And one of those proxies, Scott Hoffman, who was co-CEO and on the management committee, he's stepped down. And so that's not a great indicator. And then his replacements, it's unclear. The firm is debating whether, in becoming chosen as being on the management committee, does that mean he's also co-CEO? There's some debate there. And then this gentleman who was now in this role, he tried to fire the other co-CEO, Kardashian, being in the role only a couple of weeks.
It sounds like it's time for a divorce, like a real divorce. You know, somebody has to take his assets and leave. Bloomberg's Hema Parmar covers the hedge funds for us. Coming up in the next hour, we sit down with Oaktree Capital's co-CEO Armen Panossian, plus retired U.S. Army Major General and Academy Securities Head of Geopolitical Strategy, Spider Marks. All right, we're 30 minutes into the trading day and looking at not massive losses compared to the gains that we saw on Tuesday. This looks pretty tame.
It is pretty tame so far this morning. He's Matt Miller, by the way. I'm Dani Berger. You're watching Bloomberg Open Interest. It's better, but it could have been better. It seems to be broad disappointment from the president's address last night that he didn't de-escalate.
Yeah, coming up, from hopes of peace to escalation fears once again, President Trump offers no clear timeline on Iran while pledging more aggressive action to come.
The month-long turmoil forced traders to unwind position, with some of the world's biggest hedge funds posting heavy losses in March.
And Apollo's Jim Zelter downplays concerns about private credit, even as firms, well, and the war actually, even as firms curb withdrawals amid a surge in redemptions.
We've really lost the plot on credit. We're talking, the headlines and the conversations are about this little narrow area of direct lending, 200 billion of the non-traded BDCs. And why are we here in the first place? The reality is the last 15 years, credit has compounded great returns for investors around the globe, and they've done it in a manner which beats the high yield and loan indexes dramatically. And so we're talking about a little bit of skirmish on the sidelines here.
Meanwhile, some investors are concerned. One of the Blue Owl BDC is reporting that they're seeing a 41% redemption request. Oaktree co-CEO Armen Panossian says that this isn't a private credit problem, it's a vintage problem. And he joins us now. Armen, thank you so much for joining. And I think this is an important part, that you go on to say that there is a reason for investors to be concerned. What is that reason?
Well, there are both risks and opportunities now in private credit. As we saw rates rise, rates overwhelmed the return profile of private credit. Now, as rates are declining and spread is more of where you're getting the income, that's where credit selection really matters. I think with private credit in particular, we are seeing a difference in vintage in terms of performance. It's a several factor conversation here. First is we are seeing weakness in the software sector. We're seeing some concerns around marks, and we're seeing concerns around the liquidity that's been promised against an asset class that is, by its nature, illiquid. Now, in terms of vintage, it impacts all three of those. There's a pre-2022 vintage, and there's a post-2022 vintage. The pre-2022 rates were ultra low. Software was not a concern. It was considered a darling sector in private credit and in private equity, for that matter. And 2022, November of 2022 in particular, is when ChatGPT was released. And prior to ChatGPT, private equity firms and private credit managers weren't really envisioning how AI could disrupt legacy software as a service companies. So as you look at BDCs, the publicly traded BDCs that have been in operation 10, 15 years, and then the semi-liquid BDCs that have really grown in earnest since 2022, you're seeing a divergence in performance there. Now, investors are kind of brushing it all with the same brush, and you're seeing publicly traded BDCs trade at steep discounts, as they maybe should, given some of that pre-2022 vintage and the software exposure. But that's flowing over into the private BDCs, where you're seeing meaningful outflows, especially out of tech-oriented or tech-heavy BDCs, because of that concern.
So first, is this a shakeout? And two, if it is, how much longer does it last? What is the logical conclusion to all of this?
It's really hard to predict. All you could do is prepare. And I could tell you, at Oaktree, we have been preparing for this type of event in many ways. First of all, direct lending for us is not a huge part of our assets.
Wait, so to be clear, you thought that this time might come, that there could be some nerves around some of the bad vintages?
We always put our client interests first. So what that means in the context of this type of product where you offer liquidity, it means you have to conduct your affairs in a very prudent or conservative way. Having liquid assets that you could generate cash, not excessively levering the portfolio, being able to draw upon multiple levers for you to return that capital to investors to the extent they call upon it. We couldn't predict what happened now, but we did prepare. And this has prepared us to be on the front foot, actually, and take advantage of some of the volatility we're seeing. At Oaktree and at Brookfield, we have a long history of investing in, through cycles. In the case of Brookfield, as an owner-operator and with deep expertise in certain types of assets. And in the case of Oaktree, as one of the largest distressed debt managers in the world, and with Howard Marks's highly principled way of investing and not growing for growth's sake when we absolutely could have, has positioned us well now to take advantage of some of this volatility.
Let's step back and talk about Oaktree, because I'm just a private credit tourist, but I've visited Oaktree a lot and Blue Owl of late. What separates Oaktree from these newer BDCs?
So private credit is a very broad term.
Yeah.
Direct lending is the largest and most frequent part of it. We view private credit at Oaktree as not, hived off of the rest of the credit platform or the rest of the credit opportunity set. We view it as part and parcel to the offerings in liquid credit and part and parcel to the offerings in distressed debt. Now, what do I mean by that? As we invest in private credit vehicles, we compare the relative value against other areas of credit. And when we do see dislocation in liquid credit and not yet in private credit, we slow down what we do in private credit because we think it'll bleed over. When we see opportunities in distressed debt, where we see certain industries or certain markets or certain regions dislocating, we then tone down what we do in liquid credit or in performing private credit, because that is an insight into what shoe may drop next. Now, flip side, so that's managing risks. There's also taking advantage of opportunities. When we do see large dislocated opportunities for capital solutions, we want to take advantage of those and provide those types of solutions in our private and public credit vehicles.
By the way, can you do that now? I mean, when we have massive requests for redemptions and BDCs selling assets in order to fund that, so far it doesn't look like a fire sale. They're putting out decent numbers close to par, but under the surface, are you seeing real discounts?
So not yet. The discounts, I think, for now or the sales for now are quite orderly. And look, in terms of the semi-liquid BDCs in particular, it's pretty clearly described as being an up to 5% liquidity offering or repurchase offer for clients. Unfortunately, some of the redemption requests have been meaningfully in excess of 5%. And I think that there could have been some differences of opinion or differences in style in terms of laying out those risks around the liquidity. But I don't think that those BDCs on their own are going to generate significant amounts of selling pressure. Now, what I do think can generate selling pressure or challenges are the leverage providers to those BDCs and to those direct lending vehicles. As they get a little bit nervous about true credit losses in software or otherwise, they may cut back on their leverage profile or their leverage tolerance. And that could result in sales or a need for capital solutions to come in.
So is that, and forgive my ignorance here, is that kind of like JP Morgan coming out and saying, oh, we're going to mark the private credit funds differently because of their software exposure?
Correct.
So what does that look like if you get some of the banks pulling off on their willingness to lend?
So it will mean capital needs to come in to either delever the banks or those managers that have an upside down condition and essentially a margin call. They're going to need some sort of kick-save solution in the form of equity coming into those vehicles. The third option is to fire sale.
Does it look like we're somewhere close to that, or are we on a path to that happening?
I think this is a correction. I don't think this is a systemic kind of rejection of the private credit asset class. The question becomes, how deep is that correction or recalibration? I think we're in the beginning of it, but I don't think it's going to result in meaningful amounts of distress.
So
there will be opportunities.
I mean, that's what I want to ask about as well, because everyone we talk to about private credit says, look, it's a $1.8 trillion market. The BDCs, semi-liquid BDCs are a smaller subset of that. Their software loans are a smaller subset of that. Those that can be eaten by AI are a smaller subset of that. So it seems like not threatening at all, but you must think about this all the time. Is there any way that this bleeds into a bigger problem for markets more broadly, or a bigger problem for the economy more broadly?
I think it's a question of confidence, whether the combination of the factors that you just presented in software combined with fraud, the cockroaches headline, some questionability about marks. We have seen drastic reductions in marks that cause people to say, well, wait a second, how did that happen all of a sudden? One quarter something's marked at par, the next quarter it's at zero. It's a question of confidence all the way around. I think with respect to software in particular, though, the problem is probably bigger than what you described. And there's a couple reasons why. One is there are software companies that are tagged as something other than software. For example, business services or government services. So you do need to within the scope of AI risk, you do need to kind of add plus some other industries. That's one. The second is when you lever some of these vehicles, as much as 1-to-1 or even more than 1-to-1, and if software is 20 or 30% of a portfolio, which is on the low end actually, some vehicles have 40% software in them. If 5 to 10% of that portfolio has true AI risk, and when a company is at risk of AI, there could be a binary outcome with that business. It could just go out of business and just be completely displaced. The losses can be, on an unlevered basis, can be quite severe. Then you lever it 1-to-1, and it results in a 10%, 15% hit to your equity, possibly.
And I know on one of the earnings for one of your funds, you talked about this and talked about a pretty rapid degradation of performance, quite problematic recoveries. So for funds that have this, have we fully understood? Because a lot of funds wrote down their loans in February saying, look, we've reflected this. Is it not fully reflected in that, then yet just how bad things could get?
I think nobody knows how bad it can get at this point. I think if I asked you a question 12 months ago about AI, about agentic AI, could it displace a software as a service legacy provider, you would say, I can't even envision what that means. Today, I think we can envision that agentic AI is quite powerful, and that any software program that you use day to day, you could go into it, bring an AI agent with you and say, can you just recreate this for me? And it's not too far out of the realm of reason to think that could actually happen. The progression of AI is very hard to predict, and therefore I think it's too early to say that the marks are, that we've seen the lowest of the marks.
By the way, does this mean that you would completely avoid software companies from here on out? Just because that's a really big left tail that is so hard to understand just how big it even is.
Yeah, I think the hurdle is very, very high. It needs to be a winner in terms of in a post-AI world. It needs to own that part of the market. It needs to be an AI-driven company. We're not going to completely avoid them, but I could tell you over the last several years, we have avoided all of these recurring revenue loans, the PIK interest loans, the paid in kind, non-cash pay. And it was really because we just didn't think we were getting appropriately compensated to take on non-cash pay interest. Now, with the benefit of hindsight, it was a good move, because as those claims rose with the non-cash pay interest, what we've seen in the last 12 or 18 months is a drastic decline in the valuation multiples of some of these legacy software companies. So your claim has grown, your V in that value has come down, so your loan to value is meaningfully higher today in those businesses than they were when the deals were done.
When I look at the circumstances that led to the vintages that we hear now are not going to be great, one of them is just a flood of liquidity, right? So much cash chasing limited returns. And it feels like that could still be the case today. Do you see that?
We're seeing a recalibration of spreads.
Do you have clients coming to you saying, like, put all this money to work, please?
We are seeing institutional clients still allocating to the asset class, yes. We are seeing a meaningful slowdown in retail. Now, I think it's more balanced, and the output of that balance is that we are seeing some recalibration of the spreads. So new deals that we are talking about outside of software are going a little bit wider, not tremendously wider, not to the level of indicating stress, but not to the same level of too much capital chasing too few deals.
Well, I also think one of the things that you're probably hinting at, Matt, too, is that you have this other source of capital come in, and that is retail. And the nature of the funds of retail ones is you have to put that money to work right away. And yes, now it's slowing, but I wonder if before that point, if you also saw some recklessness come in that maybe kind of rhymes with what you saw in 21 and 22.
Yeah, I mean, any time that in a short period you do get meaningful inflows and cash drag creates a big problem for returns, then you do see excessive risk-taking in any asset class. That's true in equities, that's true in credit, that's true in private credit. And we have seen that definitely over the last 5 or 6 years, and it was compounded by the fact that every year for the 5 or 6 years, there has been some sort of curveball that has created a condition where M&A or LBO deal volumes were lower than expected. So we had COVID, then we had a good year after COVID in terms of LBOs in 2021, but in 2022, this thing called inflation was not temporary, it was permanent all of a sudden, and rates drastically rose, valuation multiples fell, private equity grinded to a halt. Then we had Obviously, we've had the war in Ukraine. When Trump was elected, people thought the deals would come back. And then immediately we have Liberation Day. Now we have a war in Iran. So there have been reasons why private equity sponsors have taken a little bit of a pause on deal flow. But at the same time, because rates rose, there was a tremendous amount of inflow into credit, and in private credit in particular. And when you do see it in these retail vehicles where you must deploy, if that is the entirety of your investment management firm's profit number, then you got to put the money to work. So some excessive risk taking happened.
Armen, you say you've seen spreads widen even outside of software, but not to levels that would signal stress. And I'm wondering if they don't widen to stress levels after massive tariffs and chaotic trade policy, after a war in Iran, the closure of the Straits of Hormuz, the doubling of oil, prices, BDCs getting 41% redemption requests. Like, what pushes spreads to levels that signify stress?
It's a great question. You really do need to see a continuation of the exposure of mismatched assets and liabilities. I mean, that's a very general comment, but for now at least, and since COVID, there has been a tremendous amount of liquidity in the markets. And what that has resulted in is when the markets have fallen, equity or credit, there's been a buy the dip mentality, and that's worked generally. Now we'll see if it's going to work in this period of volatility we're seeing at this point. But you have to see a crisis of confidence for that volatility to go to the sidelines and stay on the sidelines.
By the way, are you worried about any of the things Matt was talking about causing that crisis of confidence?
The breakup of NATO?
Well, there's a lot that could trigger it. Now, in terms of oil in particular, if oil stays meaningfully above $100 for an extended period of time, there are certainly people in the markets that do believe a recession can happen. And there are parts of the world right now that are experiencing recessionary types of impacts. For example, in broader Asia, where a lot of the oil that comes out of the Straits of Hormuz, especially highly refined products, or the oil that makes highly refined products, are causing a shutdown in some businesses in Asia. Now that could cascade and cause issues that create inflation in the U.S. or in other parts of the world. You can see some recession. It's hard to predict how deep it will be or when it will be or if it will be. But a prolonged war with meaningfully escalated oil prices and the tail that oil, even if the war ends tomorrow, there is going to be a tail where refined products and oil remains elevated because production has slowed in the region. You can't just turn off and turn on oil wells just for safety reasons. So there's going to be a lag effect even when the war ends. So I think that there is a growing tension or a growing consideration in the markets of a potential recession. And if this war continues, I think that could be something that we see later this year.
Armen, this has been so smart. I wish we could do this all day. Unfortunately, we're out of time, and you've already been very generous with your time. Thank you so much for stopping by. That's Armen Panossian, Oaktree Capital Management, co-CEO and head of performing credit. Coming up, Racquel Oden of HSBC. She sees a buying opportunity in tech. She's going to join us to discuss her market outlook. You're watching Bloomberg Open Interest.
Let's get a check on the markets on this. It's Thursday, but for many, it's Friday because tomorrow's Good Friday. There won't be equity trading. That's also a reason that a lot of people are getting flat right now. S&P down 0.7% is the drop, but still well over 6,500. So the levels look decent with WTI climbing 11% to $110 plus. Let's get the view from Racquel Oden, HSBC head of wealth and private banking. And Racquel, it's interesting to see that we really haven't done that poorly, considering, like I put up the S&P there with oil. And if you'd told me that the Strait of Hormuz was going to get shut for over a month and oil was going to double, I would definitely issue a sell order with my broker.
So I think you're absolutely right. While expectations in the U.S. are better than expected. And so I probably would look at it globally. So if we take a look at, since we've had, the crisis in the Middle East, if you look at the US markets overall since that, they're down 5% overall. But if I compare that to the European markets, it's closer to 8.9%. But if I compare that to the Asian markets, it's closer to 15%. Right? So clearly it has an impact globally.
Had they just done so much better, though? And also, I'm hearing a lot about, especially Korean investors, levered up.
Yeah. It really is very specifically based on the impact of the oil across the globe. And if you think about the Strait of Hormuz, there are other countries that really are relying on that. So that's where you're seeing the difference in the markets. I think what's also critical about that, though, is as you stated here, the U.S. has been the most resilient in this environment to the point that you're making. And I think that's the key that we have to focus on. So U.S. equity markets still remain clearly a focus, and the standpoint, if you take a look at the impact of our markets versus the Asian markets, clearly a very large difference between the two. And I think it's important that we then figure out in this market, which we clearly saw today, which I think many of us weren't sure what we'd wake up to, we're going to continue to see this short-term volatility. Right? And the idea here for our investors is, what do you do in this volatility that we're going to continue to see, and where should you be really focused on when you think about your personal earnings, and then importantly, what this means for your portfolio overall?
So where do you turn for that, Racquel? What is the answer?
There are many answers, but what I'd say is clearly what's important about what we're seeing in this market right now is a repricing opportunity. And in a repricing opportunity, you clearly have to stay what I call active management. Stay actively managing. And clearly what I've always said I'm very focused on is tech. And I know you're going to think I'm a broken record, but so far my record's been pretty right. And the reason why that is, if you take a look at the tech sector, once again, this is where you're going to find some great value.
But is it concerning the fact that they have sold off in the headline ping pong? I thought this was supposed to be one of the nice, safe, soft, cozy places to hide off in the market.
Microsoft lose more than a fifth of its value? I thought, their bonds are safer than U.S. Treasuries.
Yeah. So I think, again, back to my point of valuation. So if you really think about the tech sector, all of us would agree, 6 months to a year ago, we were just talking about the valuation being so high. And this is really what has happened from a repricing standpoint. So if I take a look at the PE multiple of the tech sector overall, at the beginning of the year was close to 36.7%. It's now at 21.7%. So you're absolutely right. You're absolutely seeing a dramatic shift in the valuation of the tech sector. But for you and I, as individual investors, this is a great opportunity. If you think about where we know earnings are going to go for tech long term, still really strong. But right now, the value has actually come down. So back to my statement of the broadening out of the S&P sector, which is really critical. Mag 7 definitely down, but the broadening out of what we call the forgotten 493, really strong performance, right? This is really an opportunity for us to be really looking at value beyond those Mag 7. Mag 7 was close to 27% earnings last year, has absolutely come down this year closer to that 10% mark. But if we look at the 493, their earnings last year was 8%, predicting to go to 15%. So there is value in the tech sector, and we all know fueling of AI and what's coming. We're in the early innings, and we know productivity is going to kick in, which is why the U.S. markets remain pretty resilient. Corporate earnings also up quite a bit. So
corporate earnings have been awesome. And by the way, we only have 30 seconds left, Racquel, but is there a point where if oil stays this high for another month or another 2 months that you start to worry about those earnings predictions and the U.S. economy growth?
Well, I think like anything, if this is a sustained conflict, right, I think across the board we're all going to have to reassess, right? So the geopolitical environment will absolutely continue to impact the markets. But what I would tell you about oil right now, if you take a look at that, that's really inflationary. But it's really food and energy, which is not the core of inflation. So this
it's what I have to pay for.
It's what I have to pay for, but that's not going to make...
As well as childcare, which the president says, we can't afford to pay for that because we need to fight wars.
Well, unfortunately, the Fed will likely not change rates based on food and energy.
Yep.
It's not at the core.
Racquel, great having you in the studio. Thanks so much for visiting us. Racquel Oden there of HSBC. Coming up, escalation building in the Middle East. What's the U.S. playbook? We have retired Army Major General Spider Marks joining us next. This is Bloomberg.
If there is no deal, we are going to hit each and every one of their electric generating plants very hard and probably simultaneously. We have not hit their oil, even though that's the easiest target of all, but we could hit it and it would be gone, and there's not a thing they could do about it.
That was President Trump's primetime address on Iran last night. Joining us now is retired Army Major General James Spider Marks, head of geopolitical strategy at Academy Securities and a senior advisory board member. General, it's great to have you on the program. I wonder if you think we got maybe a tighter framing of victory conditions from President Trump yesterday. Did he lay out our objectives clearly?
In my mind, he did. And I think it's we've been seeing this narrative evolve over the course of the last month, right? Clearly, what the president indicated is there are 5 objectives. These are military targets, but they all have a strategic connection, which is very, very clear. And it's the red lines are nukes, Navy, Air Force, missiles, and industrial base. And he laid it out pretty clearly that we've been able to attrit those. How you can assess that in terms of the Navy and the Air Force, it's quantifiable. In terms of the nukes, I'd like to say that we've done a pretty good job, but the assessment is we've set them back maybe 5 to 7 years. That remains to be seen. We'll never know about the nukes unless you start opening doors and you go grab the highly enriched uranium, which remains an option, but that becomes a real soldier and personnel suck if you do that. That becomes an immense mission. We can walk through that if you'd like.
Well, I would like to, General, because I feel like in deciding to go with Israel and invade Iran, we've basically committed ourselves to, or responsible to do something like that. Because now, after killing the Supreme Leader's mother and father and wife and son, he's probably very angry and may care about vengeance more than, his economic outlook. So they had 400 plus kilograms of highly enriched uranium. The president told us last June that we had obliterated that, and then we needed, 6 months later to go back to war. How can we be sure that they don't have the ability to build a nuclear weapon within the next few generations?
Yeah, a lot to unpack there, right? First of all, the word obliterate means nothing to a military guy. You either defeat or you destroy or you delay. The combination of what we did last summer and what we have accomplished right now is we have delayed Iran's ability to regenerate their highly enriched uranium. They can do that. They can do that underground. We've also seen the development of what I would say is the Colin Powell corollary. Look, when he was the sec state and when he was the chairman, the old term that I grew up with as a soldier was, if you break it, you own it. We did that in Iraq. We did that in Afghanistan. We did it elsewhere. We're now embracing, I break it, you fix it. We're going to break stuff and we're going to leave it for you to figure out what you want to do. And if you go forward with highly enriched uranium going forward, we're going to revisit those targets and we're going to make it that much more difficult. So as I indicated, the only way you're certain of that, to your question, is you got to put boots on the ground. You got to open a bunch of doors. You got to figure it out. You got to have a bunch of experts saying, yep, that's highly enriched uranium. Don't touch that. Or if we want to render it safe, this is how we do it. We want to evacuate it. This is how we do it. That's a highly risky task if it's a non-permissive environment. If we're trying to do that and we're still fighting, that's a huge task. If the Iranians don't anticipate it, but if the Iranians were to say, come on in, let's get a deal, you can take some of it or you can take all of it, that's a permissive environment. It's a different story, but still it's a very difficult one to accomplish. So there's no certainty in all of this. And having grown up as an intel guy, the only certainty I get is if I can touch it, feel it, taste it. If I can't do that, then I'm making assessments and I may be wrong.
General Marks, then what do you make of the president's comments basically saying that the Strait of Hormuz would reopen naturally? There may be some logic to this. He points out that Iran would want the money, that they'd have a economic incentive to let ships through so they can sell oil. Do you think that that is a realistic outcome if the U.S. just leaves and the strait reopens again, quote unquote, naturally?
Yeah, I don't know that it opens naturally. This is not an organic process that we're a part of. This is all contrived. The Iranians view everything that's happening, even in a peaceful day, the Iranians view the world through a very revengeful filter. So right now, it's all about revenge. We also haven't seen proof of life. We don't know that Mushtaba is alive. Whatever, we do know that the regime has changed, but it looks very much like what it did before, other than it's incredibly weakened. I can guarantee you it's immensely chaotic. It's very difficult to determine who the United States is talking with, primarily because nobody wants to show their face to the light of day because they're now a target. They're going to turn into dust, and they know that. So, and they're seeing, the regime is seeing this regime kind of collapse around them. So they're kind of waiting it out and trying to figure out how they move forward. The straits will only open up if the Iranians see, to your question, the benefit of allowing it to open up. Now, they're not going to get fees. Look, this is a global common. This is international waterways. They don't own it. No difference between that and the Bab el-Mandeb or the Straits of Malacca. Nobody owns that. The Iranians, however, benefit if Kharg Island remains in place and they can pump their 3 million barrels a day through the straits, they benefit. So that's an incentive. But the only way that they're going to embrace that is if our administration in this campaign with the Israelis determine increased pressure is going to allow that to occur. It's not organic. Or if we have some type of a negotiation that says, look, you got to allow the traffic to flow, or we're going to take advantage of our presence, these two carrier strike groups, in excess of about 10,000 potential boots, Marines, and Army capacity to force ourselves ashore just north of the straits, clear the weapon systems out, and then allow safe passage. That's a very difficult decision for the United States to make, but it remains an option with that kind of a presence. So I think the Iranians have to be incentivized. They're looking for an off-ramp, I must acknowledge, although that off-ramp to them has a much longer horizon than it does for the United States.
It doesn't look anything like the unconditional surrender that the president initially asked for. We've sent, this amphibious force there, I guess 2,500 Marines, and we have another aircraft carrier headed there. Do you expect boots on the ground, General?
I don't. What they remain is an option for the combatant commander in the region, the Central Command commander. I don't see it as intimidating the Iranians. I mean, they could care less, right? I mean, they're taking a beating right now, and boots on the ground. The second we do that, you kind of get sucked up into that terrain. If you go north of the Straits of Hormuz, that's the Zagros Mountains. That's an incredibly tough mission. If you're trying to go to Natanz, Fordo, Esfahan, where the nuclear reactors and the capabilities and maybe the highly enriched uranium is located, that's a huge difference from the Gulf into those locations. That would be a very, very hard mission. I don't think boots will be used. However, it remains an option. It can also be a 911 force if there's additional damage in the GCC with all our partners there. You've got some incredible capabilities to help unscrew a problem, if you will, on the ground with those forces. But I would not anticipate the application of force on the ground for all the reasons I described. It's high risk. Anytime you go across the shore, it's high risk. And then you get sucked into a country that is 4 times the size of Iraq.
General, not a lot of time here, but I just want to bring up to you a headline that we're getting from some of the Iranian state media that the Hormuz Strait protocol, it is being drafted with Oman for Hormuz Strait traffic. The market reaction, we are starting to see the worst of the risk off start to come in. The market is taking this as a positive. Would you, again, almost out of time here, General, but would you take that as a positive sign that Iran and Oman talking about some sort of Strait of Hormuz protocol?
Yes, very beneficial. Yes, short answer is yes. It's a GCC nation, Oman. It's always been relatively close, not just physically, but politically, and trying to embrace the regime and a voice for outside parties to try to engage. So short answer is yes. Let's look at the details.
All right, General, thank you so much for joining us. We'll have to have you back again soon. Retired Army Major General James Spider-Marks, Head of Geopolitical Strategy at Academy Securities. Thank you so much for joining. And as I mentioned, the worst of the selling now backing off. The S&P now ever so slightly inching into the green. We're still down, though, slightly. Well, I guess now for the S&P and for the NASDAQ. Oil prices, just a quick check on those. Those are still rising, but we were talking double digits before. Now it's only 8% for the May contract of WTI. For the June contract of Brent, that's up 5.7%. So still the same dynamic going on, but not as bad as it was, again, on this headline of the Hormuz Strait Protocol being discussed between Iran and Oman in order to let some traffic through. You just heard it from the general there that would be a positive to have that sort of discussion ongoing.
It's interesting to see we're coming back to gains on stocks, and yet NYMEX crude is still trading at well over $100 a barrel. I'll put GLCO up here. NYMEX crude, there you see it, 108.42. So also off its highs, but it's punchy. And I just pulled up the average national gas price. According to AAA, we're at more than $4.08 now, and that's just the average. So some of the sand states and California are looking at $7 and change for the premium stuff that you need to put in your BMW. Coming up, Shayna Sissel of Banrion Capital Management joins us to discuss what she's hearing from clients about the alts. What do they want, especially after these redemption headlines for the BDCs? This is Bloomberg Open Interest.
So as you look at BDCs, the publicly traded BDCs that have been in operation 10, 15 years, and then the semi-liquid BDCs that have really grown in earnest since 2022, you're seeing a divergence in performance there. Now, investors are kind of brushing it all with the same brush, and you're seeing publicly traded BDCs trade at steep discounts, flowing over into the private BDCs where you're seeing meaningful outflows.
Oaktree co-CEO Armen Panossian speaking to us about private credit concerns. Let's get more on alternative investments with Shayna Sissel, Banrion Capital Management founder and CEO. Shayna, Armen went on to say to Matt and myself that there has been excessive risk-taking. It wasn't just in 21 and 22, but with all the retail funds coming in, that people had to put that money to work, and that's just working its way through the system right now. What do you view as happening in this moment of private credit right now when we're looking at redemption requests as high as 41% in the case of one of those Blue Owl funds we learned of this morning?
So in March of 2025, I sat in Miami Beach on stage at the Future Proof Citywide event there, and I spoke exactly about this. The topic was public and private markets meet, and a lot of the conversation was revolving around private credit availability at the time. There was a lot of push into interval funds. There were ETFs coming to market that had private credit in the name. And I warned that when it comes to these types of vehicles, that structure matters. And that as financial advisors, because that was primarily the audience that I was speaking to, it was a responsibility of both the issuers and the advisors to look at the structure of the vehicles that these products were being offered in and think thoughtfully about whether or not those structures matched the underlying liquidity of the investments they were making. And I talked about that at length, evergreen, having to put money to work, so on and so forth. And as you can see, that was an important conversation to be having, and it was an important consideration to be making. And BDCs are not a new vehicle. The vehicles I was speaking to were things like the ETFs that were coming out in the interval funds, as well as private LP-oriented vehicles that were evergreen in structure, but not necessarily in liquidity per se. So you couldn't just go and get your money out. Either way, it was a change from how private credit was originally packaged in the market. So it's not surprising to me that this is happening, but that doesn't necessarily mean that there's pervasive systemic problems in private credit. And I think that's where there's a lot of debate right now. Private credit is
Are there pervasive systemic problems, do you think, Shayna?
I don't think so. I think that there's two parts to private credit. And the vast majority of private credit is done in what we call lower middle market. These are small loans. The definition of lower middle market depends on who you ask, but it can be anywhere from loans between $1 million to say $10 to $15 million. The vast majority of the stress in the system are in loans that are $100 million or more. And there's only like 10, 12 issuers that play in that market. It just happens to be the biggest ones that everybody's heard of. But it's also the smallest market for deal flow because the number of companies looking to do deals in the $100 million range is infinitely small. And so when something goes wrong there, it's felt across that part of the market. But the lower middle market is attractive. And that is one of the things that I think is being ignored in all of the debate that's going on right now as it pertains to private credit.
So, Shana, can I just ask, what are you hearing from clients and what are you recommending to them right now in this moment?
So that gets exactly to what I'm hearing. Financial advisors and their clients in the retail space are now scared of private credit. They don't want to talk about it. They don't want to look at it. They don't want to consider it, which is unfortunate because the lower middle market is important. And I want to stress this. The lower middle market of private credit is extremely exposed to small business in the United States. The vast majority of small businesses, which is 70 to 75% of all business in the United States, can only access capital in that space. If there is an issue with people wanting to invest in it, that suddenly dries up available capital to small business. Just think about what that could have consequences on the economy. I'm not saying there's a systemic problem in private credit, but I am saying that there's parts of private credit that could be collateral damage and affect the economy as a result. So think about that, and that's actually places people should be considering investing.
Shana, great to get some time with you talking about alts. Shana Sissel there of Banrion Capital Management. Coming up, one of the fastest growing snack brands is expanding beyond popcorn. The CEO of Khloud, Jeff Rubenstein, joins us next. And there's a Kardashian connection. We'll tell you what it is after this break. This is Open Interest.
Khloud, as in Khloud, is betting big on protein. One of the fastest growing snack brands, co-founded by Khloé Kardashian, is expanding beyond popcorn, announcing the launch of a new protein chip, riding the wave of America's protein obsession. Here to talk about it is Jeff Rubenstein, CEO of Khloud. Jeff, thank you so much for joining us. And I just gotta wonder how the desire to spend for fancy protein-laced food is comparing with just general consumer appetite right now. Because so much is being said on a consumer that's pulling back, that's less willing to spend more. How do you see your audience behaving, and how does the introduction of this new chip play into that?
Good morning. Thank you so much for having me. Good question. So if you look at what's happening in trends generally in consumer packaged goods, the thing that we're finding is that for many consumers, there is a very significant difference between choosing a commodity, which has basic fundamental needs, and choosing a brand that has an emotional attachment, a brand that has a connection to you culturally, a brand that fits your lifestyle, a brand that you're proud to be seen with. Our focus at the moment is not about introducing new products that satisfy hunger, although that's part of the equation. We want to do as much as we can to introduce new flavors and protein functionality. But ultimately, our goal is to connect with consumers on a different level. And if we can decommoditize, if we can deliver flavor and function and do it in a way that connects with people at a visceral level, at an emotional level, we think that consumers are okay to spend a few extra shekels.
So how do you do that? And I imagine there must be some kind of Kardashian playbook, because any business connected to this family is so successful. It doesn't matter whether it's makeup or underwear or popcorn. What are the tenets of running a Kardashian business?
Yeah, I think that the Kardashian brand gets you significant visibility, but it's important to balance celebrity and community. So we're very focused at the moment on building out a ground game, right? We invest in email and SMS and digital partnerships and influencer programming. The key is to leverage their visibility and add to it very significant credibility.
I'd imagine, though, that Khloé Kardashian is very busy. How much of her time can she put into the company?
I'll tell you, I've been very fortunate over the years to work with a lot of really fantastic big names over 26 years in the consumer packaged goods space. I've never worked with a partner who's more committed, who's more engaged, and who doesn't think about this as an assignment, but thinks about this as a passion. We don't have a long list of deliverables in a contract. She is a partner, and I mean that in every sense of the word.
So what do you think it is about this family, these sisters, that drives them to be so successful in business? Because they've all pretty much made money already. Like, they could just hang out in Miami Beach or wherever they drive G-Wagons, but they seem to continue to work so hard.
Yeah, I think success begets success. And they've spent a lot of time thinking about this particular brand This is not an overnight success. This has been something in the works for many, many years. And Khloé, as you know, is a bit of a famous snacker. She had a pantry in the house dedicated to snacks. She spent a lot of time consuming some of those snacks, and she realized at one point it was time to get clean. And so she focused on her diet, she focused on her fitness routine, and she changed out the pantry. And as she did that, she sort of began to develop a protein popcorn idea that we thought had a lot of potential, first to market. And now we're introducing a tortilla chip that's potentially going to be even bigger. So she's super committed and very emotionally engaged, and it seems like she just has the magic touch.
Hey, Jeff, we're going to have to end it there. Thank you so much for joining us. Jeff Rubenstein, CEO of Khloud, with a new protein chip on the market. Let's get a check on markets this morning because we are pairing losses this coming, according to IRNA, one of the Iranian state media, citing the Iran deputy foreign minister, that they are drafting a protocol with Oman to monitor traffic through the Strait of Hormuz. That's maybe positive, at least for the equity market, that some flow will be coming through the market. But, Matt, it is notable that NYMEX and Brent are still both trading above $100 a barrel. But we're talking with General Spider Marks, who said that it was a positive thing to have a nation like Oman being involved in the project of reopening the Strait of Hormuz.
We should point out to viewers who are saying, like, why is WTI trading for more money than Brent, that these are for different months? Right, so
yes.
We were talking about this this morning. Javier Blas has been tweeting about it. The reason is that you're looking at the May contract for WTI and the June contract for Brent.
Yes, that is very correct. Okay, coming up on Monday, Stuart Kaiser of Citi, in Johnny D of FTSE Russell, and the Clear CEO. In the meantime, enjoy your long weekend.